That was fun, like playing and toying with our audience on Microdose when we had 3 minutes of silence. It was like some sort of, who is that? John Cage, Philip Glass. Which one was it more like?
I think it was John Cage. He did that suite that was music that was complete silence. Complete silence, I believe. Yes, indeed.
So that was our artistic expression there in the last Microdose.
There was a clubhouse recently that was complete silence.
Really?
That people were talking about. It's like a meditation clubhouse. There was complete silence. It turned out later that it actually was completely empty except for Corey Clipstein. Clipston. Corey.
Right.
Corey Clipston. He was the only one in, it turned out.
That is funny. Of course, Corey Clipston is from swanbitcoin.com/orange pill. Yeah. Should you choose to want to smash sats while you get smashed with us on this, I believe this is Saturday morning. It could be Sunday morning. It all depends on where you are.
I like to breastfeed my swan. Here, little swan. There you go. Drink up. That's how swan gets its satoshis.
Right. So we're going to talk today about the mindset of the fiat people, the mindset of shitcoiners, the mindset of people with bad money. Because you know how Oprah is kind of the epitome of that, the Oprah Winfrey show, and she used to do, you have a free car, and you have a free car, and you have a free car. Well, you know, that reminds me, of course, of the shitcoin conferences and the lead up to that whole ICO boom. And during that ICO boom, it was the whole meme at the time was when Lambo, because everybody was dumping bags of shitcoins on other people and using that to buy Lambos, not to build any sort of, you know, sovereignty or censorship resistant sort of like future, positive future. And instead they were all after the Lambos, just like what Oprah Winfrey is giving away on her show all the time. Well, we have that in the headlines here. Consumers pay whatever it takes. Vehicle prices go nuts. Dealers make record profits. Whole mindset changed. Is this inflationary really temporary? Wolf Street asks.
Oh, yeah. Yeah, I saw the headline, and I'm sure you're going to get into some of the details there. It makes no sense. And as you pointed out earlier, this is similar to when oil prices went negative. Remember that a couple of years ago? That was market failure. Remember, we've got a situation of negative interest rate bonds. That's an example of market failure or a default. And now in the car market, which is more of a consumer item, and you see total market failure.
Right. So one of the things, so when the whole when Lambo era happened in 2017, in case you weren't there, what happened is, you know, you would launch an ICO, you would claim in a white paper that you were going to do all these amazing things. People would send you their Bitcoin, they would send you their Ethereum or dollars, whatever it was. And they would send it to you and say, yeah, we're hoping this token we could flip for some other, you know, on some other chump in the future. But in the meantime, these chumps, the first round of chumps, gave you all their Bitcoin. And what did you do? You went out and spent it before they could take it back, right? Or before your token crashed to zero, because the founders of those tokens, they had huge piles of these tokens, right? So they would dump them as soon as an exchange listed them. They would pay the exchange $1 million and then dump it as fast as possible. And when you dump it as fast as possible, they're doing that because they know their token's going to go to zero. So the same thing you could see happening in this market. So people are dumping their dollars as soon as possible because they're afraid it might dump to zero, that they're not going to be able to buy a car, an automobile, which is a depreciating asset, right? Like you wouldn't think that the headlines and the story, the details I'm going to give you here would make sense. But what is happening is people are actually, for the first time in our history, they're actually offering over the sticker price. Usually you go there and you're like, hey, it says 25,000. Well, actually right now the average price just paid in June is 40,000. So it says 40,000. I'll give you 35,000 cash, right?
This is like a car dealer's wet dream. Probably never in the history of car dealers has this ever happened, where people come in and offer you a price above the sticker price. Usually the sticker price is notorious as being, a little over what you could get with a little haggling, right? And then that gave rise to websites or apps like Carvana or others where you could get the lowest possible price. And this was the whole thing about buying a car. It's the low price. So here in 2021, everything's turned upside down. People are actually offering above sticker price.
Again, that's not a price signal that's normal. It's not a mindset that's normal. And it's caused by the abnormal monetary interventions of the used car salesmen that are the central bankers that are basically pushing a lemon of a monetary policy system upon us. And therefore you see all these unusual activities. I mean, you see this in, it's a classic trope of films where aliens arrive and things go weird, like frogs fall out of the sky or something weird happens. So all these things are the Matrix, like the cat walking backwards, the deja vu moment, like all this stuff. None of it adds up unless you can step back and look at all the physics of the picture, which includes all the Fed monetary policy intervention, now all the stimulus being printed way above and beyond the capacity of the actual economy to produce those goods.
Yeah, exactly. The Matrix moment or the science fiction trope, but this all applies. This is not a functioning market. This is a market failure, and it's throwing off wild signals. And as a result, people are really in a state of perplexion.
Yeah, and this notion of you get a free car and you get a free car and you get a car and you get a car. Yeah, that's kind of like what you saw in the Soviet communism, right? Everybody got a free car or free house or free whatever.
But right, you had to go on a waiting list though.
Yeah.
So I think that's going to happen in the U.S. You're going to see waiting lists and rationing. And we just went into a store to buy some stereo equipment, as it's called, and the shelves were completely empty. And their backlog is huge. They're missing parts. They're missing components. Nobody in the store knew anything about it, how to explain it, or how to assist in any way. And that's repeated in commerce all over America. Then you go to the gas station, prices are on the rise, and it looks like there's going to be disruptions this summer. They're running out of gas, right? That's a Soviet Union type failure of markets.
Right. Now you're seeing that in the car market as well, because there are waiting lists to get new cars, to get the new vehicles, and it's because of the supply shortages. So apparently the Fed and the Treasury assumed their models that they don't know are totally broken now. Their models show that if they give more money to everybody, then the supply will arrive because producers will, they have profit to make. They're going to sell more goods, right? They're going to manufacture more. That didn't happen.
Right. It's exactly what Soviet Union leaders thought, that if they increase the supply of tractors, they're going to have a lot of food. And that didn't work out. That you have to let the market decide where the sweet spot is for supply and demand. You can't dictate from your ivory tower or from some political office where that sweet spot is, because we know from history that that's an impossibility for anyone to figure that out. It has to figure itself out. That's what creates the
price discovery
equilibrium, that the price discovery, right? This is what Adam Smith figured out in 1776 with the publication of Wealth of Nations. So again, it's weird. It's like collapse gap, what Dmitry Orlov wrote about 14 years ago, I think, how the U.S. was poised to collapse just as the Soviet Union collapsed. There would be a delay, but they're both kind of were on a coterminous path of both collapsing with a slight stagger in timing, but for the same reasons, and now we're seeing it.
So they mentioned this car called the Kia Telluride as an example. There is a backlog of those. It's going to take a year to two to receive a new one. The new one, the sticker price is something like, say, $43,000. The used ones with low mileage on it are like 47,000. So they go for more than the new ones because of the waiting list.
Right. So the car market's in backwardation.
Yeah. When Lambo, it's literally now when Kia, because of the shitcoin called the US dollar.
Right. So the short-term market for used is trading above, waiting for the delivery of the new. So it's in backwardation. You see that, I think, actually in the oil market right now, the short-term contract in the oil futures market is trading higher than the longer-term contract. We've seen it before in oil market, gold and silver. In commodity markets, you occasionally see backwardation, as it's called. Now we're seeing it in the car market, which makes no sense.
But except for financialization and shitcoinization, right?
Yeah.
Like that's what financialization turns everything, all the basic necessities, whether it's housing or food or things like that, like it turns healthcare, education, all that stuff has been financialized. So, none of it makes sense.
Well, there's a fear of missing out developing because people are getting a lot of the free money. And so their time preference is very, very high. They're not going to shop for value. They're going to shop for immediacy, because they know that more free money is coming.
Yes.
This is the beginning of hyperinflation. This is what happened in Venezuela and other countries, in Argentina, is that people rush to buy stuff because they know that prices are going to be jacked up because the government is out of control printing all the money. So remarkably, in America, the mainstream media is not reporting on the beginning of hyperinflation and dollar collapse here in America. They're focused on things that are absurd, like UFOs are becoming a big story. Why are UFOs a big story suddenly? Because they don't want to talk about hyperinflation and the collapse of the US dollar.
Exactly. The hyperinflation is a mindset. Remember, it's not necessarily just printing money, because you can print money for a long time. A lot of developing economies have very high inflation for a long time. They're booming developing economies. You have high inflation and it keeps things rolling over, and that shitcoinization. But when people lose faith in the system itself, then they start racing to get whatever goods they can. You saw that in the durable goods orders. Everybody's buying, refrigerators and washing machines and stuff like that while they still can, while China will still send it to us for these cheap prices, while they'll still take our dollar. So there's somewhere inside us collectively, we're behaving as if all this weird price signals over the past 2 years is dawning on everybody that shit is about to get fucked up, right? So when
you don't hear that on mainstream news, that's for sure.
No, Jim Cramer doesn't tell you that, right? And yet, so we covered this on Kaiser Report before we were doing Orange Pill podcast, and we covered when interest rates went negative and bond yields went negative. As our guest is about to say, and Greg Foss, that's not an investment, right? And in fact, it's assigning negative value to time. And then that period of time when, mostly because of financialization, we saw energy prices go negative. Like it actually printed negative, $30 or something a barrel. It was crazy. Like these are like the laws of physics were broken, of financial physics were broken. And this is just like it's part of the same ripple, like the waves traveling through the economy of the Fed, the Wizard of Oz, like manipulating everything and not accounting, like looking at that bit that they want to manipulate, the JP Morgan's balance sheet, and not seeing over here what their money printing is doing.
Yeah, well, it's definitely a mindset. I saw it a few years ago developing the secondary market for sneakers. So suddenly sneakers, from vintage sneakers and limited issue sneakers, became huge business, of people paying hundreds of dollars, thousands of dollars for a pair of limited edition sneakers. I mean, this is how people with a few $1,000s to work with, instead of a few $100,000 or a few million to work with, are participating in the collapse of the US dollar. The only reason these things are happening is because the purchasing power of the dollar is collapsing. To turn sneakers into a rare commodity that's traded on an exchange, and there's one in Chicago called StockX or something like that. Detroit. We visited them when we were visiting Detroit, the company, the spinoff from one of the other big companies there. And so to see this develop, you realize that there's a dying thirst for things that don't depreciate in value, that hold their value against money printing. And so that's, again, the Bitcoin story.
Right. And, just to put into context, just the extraordinary nature of it. First of all, I'll just show you a chart here, the average transaction price for new vehicles. So this goes back to 2014. You can see the parabolic move there as everybody's receiving all their free checks in the mail. They're obviously, spending it, and they're not haggling. You always assume when you go to the car dealership you haggle, right? But they're not haggling.
Okay, so one of the big, I'm really curious what Jeff Booth has to say about this. He wrote The Price of Tomorrow, which is that deflation is built into the system, and that technological innovation and the price of the basic commodities of the new economy, bandwidth and chip speed and storage, are crashing. Therefore, you cannot print enough money to create inflation. That deflation is a permanent feature. But it seems like we've crossed over to a new paradigm. It seems like we do have inflation. And so how does his model account for this? I don't know. I got to ask him.
Actually, I just sent him a DM literally moments before we started recording this to see if he could talk about this. So hopefully we'll have him on Kai's report or one of our other programs shortly. But the total profits from new vehicle retail sales in June for all dealers combined have jumped by a mind-boggling 175% from June of 2019 to 4.4 billion. So that consumers, this is Wolf Richter in wolfstreet.com, his opinion on this. And by the way, his background is in auto dealership stuff. So that consumers allow dealers to make that kind of mind-boggling profit per unit shows that the normally tough, astute, and haggle-eager American car and truck buyers have become laydowns. Most of them could have waited a year or two before having to buy a vehicle, but no, suddenly price does not matter. And that's a scary thought from an inflation point of view.
Now, wolfstreet.com with our friend
Wolf
Richter has done so much great reporting over the years, and he does have this background in car dealing, car business. And this is a startling report. This is a must-read report. It's really startling. People become laid down, I guess is a term in the industry to suggest that no, the guy's just going to take the price. He's not going to haggle. I mean, they're paying the over a sticker price. And so to your point, the mindset has changed. And we know from history that once the mindset changed toward inflation, it's the genie that you can't get back in the bottle. People they just don't believe you anymore that the value of their dollars aren't going to lose purchasing power, that they just don't believe you. So they're out there and they're buying any price.
They don't believe that the dollar is going to gain value, but also what they don't believe is that the free money will end. The free money has not stopped since 2008 for Wall Street. And I think the consumer, the ordinary American, believes the same thing is going to happen.
Yeah, that's a really good point, because the Fed, they meet up all the time and they have their press conferences and they always threaten to stop the free money. They've been saying this since Bernanke, when asked during his time at the central bank, the Federal Reserve Bank. He said, well, we could reverse the free money in 15 minutes. We could just reverse this policy in 15 minutes. Don't get hooked on the free money, because the second we get back on track, we're going to stop the free money. And people like us and others would saying, it doesn't make any sense. That's impossible, because the whole system, if you took away the free money, because it's a Ponzi scheme, it would collapse immediately and it would have catastrophic results. They're just going to keep their free money going. So that message was not understood or wasn't taken on board.
They didn't believe
They didn't believe it for 20 years.
They knew for a fact they were in charge. They were in control. And you see that now with the population in America. They know they're in control now. They're in front. They're in control. Who was it? Jefferson? Which one? Ben Franklin? Somebody warned, one of those founding fathers warned that once the people realize they can control that money printer, it's all over. But that mindset seems to suggest that they know that they're in charge, that the government's going to keep on giving them free money.
They don't believe these warnings about tightening anymore.
No. They
don't believe it.
Otherwise, they would save that money, right? Instead of buying cars at, offering over the sticker price.
So when they say classic sign of hyperinflation is loss of confidence in the money.
Yes.
That defines hyperinflation.
Yes.
Loss of confidence. So I ask you out there, if in fact the general public has stopped believing the Federal Reserve warnings that they're going to restore credibility to the currency and they're going to stop all the free money printing. And those words go on deaf ears and nobody believes them. Are we or are we not entering a period of hyperinflation?
That's the Fed and the central bank. They control Wall Street. They control the credit spigot. Over here is the U.S. Congress, the House of Representatives, and the Senate. And for 40, 50 years, Max and I remember when in the 80s, it was all, we can't have deficits. We can't have deficits. High deficits, no good, right? All that stuff. We can't spend, tax and spend, all these warnings. What happened? Every single president kept ratcheting up the debt. None of them actually cared. All those warnings that they say they're going to do, they never do it. So the mindset of the population itself, forget Wall Street, forget the credit system, forget that, all the thing the Fed controls. But now the Treasury and the government itself, the base money layer, people are saying, we know you're going to keep printing money. We know you rack up deficits all the time. We know it all goes to the military industrial complex and all the big agra and all the other oligopolies. We want to cut now, and we're going to get it, and we know it because we've seen it, and we've seen that you won our votes because we know that if you give us 10,000 a year, as they've been doing, that gives you license to give your buddies $1 million a year, or 2 million, or 10 million, or $1 billion a year.
Yeah, right. And for this to appear in the car market is really the telltale sign, because the car market, it's a huge industry. It's very much part of the American dream, the American psyche, is the America's always thought the car is that wide open road. The car is, the Henry Ford in the beginning of the car, the highway system. So it's one thing to talk about all this in the derivatives market, because people don't understand what's going on in the derivatives market. They have no relation to it. But in the car market, I've often said that there's only really one point that the public interacts with the economy, and that's with gas and the cars.
Gasoline prices, right.
Prices. So that's the only time anyone really knows they has a signal about what's happening in the economy. Other than that, it's very, very arcane. They don't understand what's going on. Right.
Well, that's what Wolf Richter often points out. That's the number one consumer market is actually automobile sales. Right. So I think this is a good time to cut now to, we're talking about the credit markets with our guest, Greg Foss. And it's a good segue from this, like the whole mindset changing and where we go next from here.
All righty. Welcome. Time back now to go to Greg Foss. He's a former bond trader turned Bitcoiner, Stacy.
Right. Greg, welcome to Orange Pill Podcast. Your recent piece is called Why Every Fixed Income Investor Needs to Consider Bitcoin as Portfolio Insurance. So, the whole bond market and the credit side of the markets is something that goes really vastly undercovered, even on mainstream financial news like Bloomberg or CNBC. They cover equities. Everybody loves the stock market. Everybody loves the number go up there, of things like Tesla and all the Robinhood traders and stuff. But just give an overview of the actual bond market and the credit markets. Like, what is that and how important is it relative to, say, the equity markets, the stock markets?
Well, great question. Firstly, thank you so much for having me. It's a pleasure to be on your show. I'm a huge fan. So coming to you from Canada, a little bit of background very quickly. I've traded credit for over 30 years, and most of my credit counterparties are in New York City. So while I'm based in Canada, I trade predominantly with predominantly with the large US investment banks. And why is credit so important? Very simply, it's a much bigger market. In relative size, the credit markets are about 4 to 5 times the size of global equity markets. They have a priority of claim. So in the event that a bond is not worth 100 cents on the dollar, the equity of the same company is worth 0, just in a priority of claim. So you can imagine that if a bond holder needs to hedge their credit risk, they can run to the equity market and purchase put options on the equity, or they can outright short the equity. So frequently I say that credit is the dog, and equity is the tail. The tail gets whipped around when credit hedge funds like myself decide that they are going to short the equity and own the bonds as a hedge against the potential default of the bonds, or rather, if you feel that the equity is overvalued and the bonds are undervalued. So equity has a priority of claim. It's a bigger market. It's played by sophisticated institutional investors. And that's why generally you don't see it on CNBC or Bloomberg Radio as much, because the typical equity investor has no clue, firstly, what the rating of the bonds are of the same company they own equities in. And secondly, it's traded over the counter. It does not trade on an exchange. So it's not like you can follow it like you can follow the equity market.
Right. So, when the Fed intervenes in the markets with interest rate cuts and quantitative easing and all this stuff, all Bitcoiners know this notion of money printer go brrr, right? So who is the Fed actually rescuing? What is their intent? Do they need to do this? What is actually going on behind the scenes? Everybody thinks it's to rescue Wall Street, to rescue the stock markets. Is it something bigger? Like, especially this last round since 2019, something happened to the repo markets. Like, weird stuff happens that nobody knows about.
Well, the reason we don't know about it is because it's not covered by mainstream media, but every credit trader knows that the gurgling starts in the plumbing of the credit system. So things, as you mentioned, the repo markets, the interbank market, swap markets, the TED spread. So that's the Treasury to Eurodollar spread, all indications of financial stress in the system, which tends to cascade down the capital structure and magnifies itself in things like equity volatility and equity market sell-offs. So essentially, the Fed is concerned not with equity markets per se. It's mostly concerned with the smooth functioning of the credit markets. And the equity markets get pulled up by the smooth functioning of the credit markets. And conversely, the credit markets get pushed down when the plumbing of the credit markets gums up. And very simply, the Fed will go in to try to maintain the liquidity in the system. And when we are levered as highly as we are, which is just a mark of the capitalist system, they are predominantly trying to rescue the banks. Stacy, by the banks, I predominantly mean the commercial banks. And the reality is most commercial banks are levered at least 15 and even 20 times, which means for every dollar that the bank lends, they only hold $4 to $5 of equity capital against their loan exposure. And how often do you think a loan loses more than 4% of its value? Well, fairly often, right? So that means that in many instances, the banking system is over-levered and needs backstopping by the Fed. And a little aside note, when I graduated, I actually went to school in the US and came back to Canada. When I graduated in 1988, I was working for Canada's largest financial institution called the Royal Bank of Canada, and it was insolvent because of Latin American debt exposure. Hence the Brady Plan in 1988, which rescued global banks. It was my first exposure to the backstop that the Fed put in place to rescue the global banking system. And it's happened like in regular cycles. The next one was long-term capital management in 1998. Then we all know the great financial crisis in 2008. And most recently, the COVID scenario, where the Fed did something unprecedented. It came into the market and started buying high yield credit. And the reason it had to start buying high yield credit was because of 4 different US corporations that were on the brink of downgrade from this mythical investment grade category down into high yield. They were General Electric, General Motors, Ford, and AT&T. And the combined debt of those 4 companies would have overwhelmed the US high yield market. They themselves are bigger in combination than the entire high yield market in the US. And if that had happened, you would have seen a cascade effect where the equity would have been crushed more than it already was being crushed. And the Fed did unprecedented things and came in and bought high yield credit. The first time in my history I've ever seen that happen, and likely not the last, unfortunately.
Right. So you used to have something called the business cycle, and this would show up in the bond market, and the central bank was a lender of last resort. Under Paul Volcker, things got out of hand here in the U.S. He raised interest rates, and but that's all gone, right? We have an activist Fed now, and their job is to buy every piece of paper that comes out of Wall Street to make Wall Street rich, right? So there's no price discovery, right, Greg Foss? I mean, we're beyond this notion of price discovery. If someone says price discovery, they would get laughed out of the room, right?
I agree with that, Max. Essentially, what's happened is there's an elephant in the room that is manipulating the base layer of risk, that being the quintessential risk-free rate, being the U.S. Treasury yield. When I started trading in 1988, the U.S. Treasury yield was 14%. Okay, now it went under 1% in the 10-year. We have an elephant in the room. The reason we have an elephant in the room is you cannot allow rates to increase anymore, because we've increased our debt burden so large that if in an increasing rate environment, the debt burden, just the interest expense on the debt burden would outpace the growth of the economy. It's pure mathematics. Mathematically, it's impossible for the Fed to let rates rise even by 100 basis points. I think that it was Stan Druckenmiller that pointed that out. He said, look, in an environment of 3.5% 10-year yields, the U.S. loses reserve currency status. And I agree with that mathematics. It is absolutely 100% certain that currencies debase when you have a total global debt to total global GDP of 4-1. And that's what we have now. So currencies are absolutely 100% certain, fiat currencies, to debase. The Fed is in there to try and maintain the liquidity of the system, but they cannot let rates rise back to an open market determination of what the proper base rate would be.
Right. So, that's why people are buying Bitcoin, is that they know that currency debasement is guaranteed. Again, the Fed, whose primary purpose is to achieve some kind of stability or equilibrium through the machinations of the Federal Open Market Committee, they stopped doing that under Greenspan. The so-called Greenspan put became the Bernanke put, the Yellen put, the Jay Powell put, right? So Bitcoin, the reason Bitcoin right now is so high is because that market does have price discovery, and it's telling us that this global central bank cartel is in the process of blowing up.
I would agree with that. It's well said. Here's what I do also know. Bitcoin might be high in price relative to where it's been historically, but it's by my calculation, it's about 1/3 of its intrinsic value. In my paper that Stacy mentioned, and I apologize for the long title, but the reality is, if you use the credit default swap market on sovereign nations to price Bitcoin today, Bitcoin's worth, by my valuation metrics, at least $150,000 per coin. That's based on current credit default swap spreads in the open market. So that is one remaining open market price discovery, Max. And if you use that metric as essentially an anti-fiat, that's what Bitcoin is an anti-fiat. And if Bitcoin is the anti-fiat or default insurance on a basket of fiat currencies, using that methodology, Bitcoin's worth at least $150,000 today. And still that's cheap relative to where I think it could go. So, there's an intrinsic valuation based on open market rates that are not manipulated, because the Fed is not in the credit default swap markets. And that's very key.
Right. So just back out of that number for me. So you're talking about a roughly $2 trillion fundamental value of Bitcoin. Correct. And based on the free price, the markets that are happening, the price discovery that is happening. But so that's in relation to some interest rate metrics.
It's called credit default swap. It's an open market for the purchase of default protection on a given entity. Now, in to a little bit of history. In 2006, you could buy default insurance on Lehman Brothers for 9 basis points per annum, which meant it cost you $9,000 per year to insure $10 million of Lehman Brothers debt. Okay. Everyone assumed Lehman was too big to fail. They were picking up nickels in front of a steamroller if they were selling that insurance, but there were smart buyers of that insurance, because 2 years later, in 2008, 2009, that insurance was worth $6 million. Okay. From $9,000 a year, it turned into a $6 million contract. Very simply, it's the open market insurance on a given entity. And
right.
that insurance
are there
exists,
CDS? Is there a CDS market on Bitcoin right now?
not on Bitcoin. It's a CDS on sovereign nations. So the United States has a default swap market. Canada has a default swap market. Every country, as a function of their credit quality, has a default swap market that is a buyer or a seller of default protection at a given level.
Okay, so how do you extrapolate that $2 trillion number?
Okay, so you take all the debt that, let's run through this with the United States. The United States owes about $30 trillion in funded liabilities and another $160 trillion in unfunded liabilities. Okay, Medicare and Medicaid. So to make the math easy, let's assume that the US has $200 trillion of unfunded and unfunded liabilities that citizens are counting on. Well, the current open market rate on credit default swap on the United States is 10 basis points. If you take 10 basis points and you multiply it by $200 trillion, okay, that is what the component of Bitcoin is worth, is protection of the United States. And you do the same thing, you go down through G7 nations and you do it on a basket of G20 countries, you get an amount that adds up to, as you mentioned, about 2 trillion, a market value of over $2 trillion US dollar. Of over $2 trillion US dollars market cap for Bitcoin, or in other words, $150,000 per Bitcoin currently. Now those spreads are dynamic; they change as the perceived default probability of a nation changes. People will pay more for that insurance, and therefore the intrinsic value of that insurance product will change as well. That insurance product is called Bitcoin. It's the anti-fiat. There is no counterparty risk. You buy Bitcoin, you are not exposed to the counterparty risk of the insurance company that sold you the insurance on the US Treasury or the Bank of Canada or any of the basket fiats.
That's pretty brilliant. So Bitcoin is a credit default swap, you're saying, for any portfolio manager. It reduces their risk in their portfolio.
So let's think of well said, Stacy. What is a bond to begin with? It's a fiat contract, right? And that's hilarious when you think of it, because if you lend somebody $100 at time zero, particularly the U.S. Fed, you'll get your $100 back most likely in 10 years, not with 100% certainty, but with a high degree of certainty, 99-ish% certainty. But the value of that $100 in 10 years, we all know, is going to be a lot less than the current purchasing power of $100 today. So every single fixed income manager in the world has this exposure to this fiat contract. This fiat contract has the same problems as the fiat currency itself. It's a serial debaser. It's 100% certain mathematically. So yes, I looked at it and I said, from my credit market experience, much like leading up to 2008, 2009, you could have bought protection on Bear Stearns very cheaply. You could have bought protection on Lehman Brothers very cheaply. Now, Bear Stearns was rescued by JP Morgan. We all know that, but Lehman Brothers wasn't. And not only just because Bear Stearns was rescued didn't mean the value of that insurance company contract didn't increase meaningfully. So it didn't have to default in order for the insurance buyer to have made a lot of money on a mark-to-market basis on Bear Stearns. Same thing, I apply the same logic to sovereign nations. So we all think, okay, yeah, it's a very low probability that the US is going to default. It's not zero. Again, it's a low probability, but Canada's more risky than that. and you go down the spectrum down to something like a Turkey, and all of a sudden there's a real chance that defaults. And obviously that provides intrinsic value to the default insurance that Bitcoin is.
Yeah. It's a blended CDS of global sovereigns, or you're focused on the U.S.?
No, it's a blended basket, Max, correct, of global sovereigns.
Right. And so let's turn, because you had mentioned Stan Druckenmiller, and Stan Druckenmiller was recently on the financial news, and he mentioned that he used to be what was called a bond vigilante. Bond vigilantes have been annihilated, I guess, through quantitative easing. They were taken out back and shot. So he's now into Bitcoin, and it sounds like he's similar to what you're seeing. So let's go into the mind of somebody like yourself or Druckenmiller or Paul Tudor Jones. Like, why are you in particular, what sector of the investment community are you guys coming from, whereby you see the value of Bitcoin, not only for its 24/7 trading, its liquidity, all that stuff? Like, do you think he sees what you're seeing in terms of the credit default swap?
I believe he does, and I would never put myself in the same class as Mr. Druckenmiller or Paul Tudor Jones, but we look at the same warning signals. Again, you will know far before there's a blow up in the equity markets if things are getting unstable by looking at the credit, the signs in the credit markets. You remember in 2007, famously, Jim Cramer got on TV in the middle of summer, and he had his rant that the Fed knows nothing. They know nothing. And he begged for the Fed to cut rates to relieve stresses in the system. And they did, and equities rallied to a new high, but the credit market never for one day bought that anything had changed. In fact, the credit system started gurgling even more. And lo and behold, 4 months later, the equities, after hitting fresh highs, were collapsing meaningfully into 2008, 2009. We all know how it happened and ended. How did it end, Max? Very simply, we just transferred all the leverage in the financial system to the leverage of the government balance sheets, and now we are snookered. There is no way the Fed can ever allow open market interest rates to approach anywhere near where it should be if there was no elephant in the room with quasi yield curve control or $120 billion. $120 billion of assets that are being bonds that are being purchased every day. So, this is unfortunate. Well, it's not unfortunate. It's outright, pure mathematics. We have pulled forward all the benefits for our children, my generation, selfishly, just by this quantitative easing to solve the problem, which is started in 2000, or actually started in 1998 with long-term capital, magnified itself in 2008 with the great financial crisis, and then we never paid it back. Okay, we could have if we had been disciplined, but as soon as the Fed tried to taper in 2013, 2014, the equity markets got scared and the Fed panicked and backed off. They never paid down any of the obligations they otherwise should have. And then in 2019 with COVID, or 2020, it's they had to reopen the taps, the liquidity taps, without having paid down the prior obligations.
Right. Now, one time when there was an open discussion of credit default swaps, and it was really a daily news event, and that was the collapse of the Greek economy going back to 2008.
Beautiful.
Yeah. And so we covered it in great detail. We were in Athens. There was a lot of speculation that the country, just historically, it was kind of interesting that there was some shenanigans going on with Goldman Sachs, who was advising the country in a way to get them surreptitiously into the euro, and knowing that they would have a problem, and then gambling on their default in the credit default swap market.
Could very well be, Max, the only reason that the former pigs, so you mentioned Greece, but the pigs were Portugal, Italy, Greece, and Spain. The weak southern component of the euro The only reason they recovered is because Draghi went out and said they will do whatever it takes, including buying all the debt of those countries. So Greece would have defaulted, there's no question, but the European Central Bank managed to rein in the speculative purchase of, or how about not speculative, but the people realized, okay, I don't need to purchase this credit default swap, this protection, if the ECB is going to control the market. Now, Goldman is one of the most, their traders are some of the most brilliant on the street. They have different hedges and wedges in every single aspect, whether, they were betting on the outright default of Greece or not. I'm not going to speculate on that. I will tell you this, though. In 2008, 2009, there was no way the Fed was going to let AIG fail, because if AIG failed, Goldman Sachs was going to fail. Goldman Sachs had purchased so much default protection from AIG that if that insurance didn't come through and Goldman wasn't able to count on that protection versus all the protection that they had sold, Goldman Sachs would have been wiped out.
Okay, so the price discovery in the CDS market has been impacted from time to time by the machinations of various governments.
It has, but it's nowhere near as much as in why, for example, is there even default protection or a market on the U.S. Treasury right now, even though, in theory we can print, and I say we, I mean, I tuck myself under the wing of the U.S., even being in Canada. But the reality is there are people that believe the risk isn't necessarily just of default, but it's just that the risk of the country will increase over time, such that a smart risk manager needs to protect themselves against the increasing risk. It doesn't imply certainty of default. It just, like everything, implies an increased risk profile. Yes, it helped, you're right, when the ECB came in and caused CDS spreads on Greece to contract. But there's lots of other countries, Canada included, that doesn't have the backing of a very strong global central bank like the Fed or the ECB. A little footnote, Canada happens to have a higher credit rating than the United States of America by S&P. We actually have a AAA credit rating, whereas the US is only AA+. But in the CDS market, the US trades at about 10 basis points and Canada trades at 40, meaning the market is charging a far higher premium on Canada for the true risk of Canada. So what does it say? It says that the S&P rating is bunk, which we all know is generally an outcome of these scenarios. AAA ratings on mortgage-backed securities, residential mortgage-backed securities and subprime mortgage-backed securities, we know are what caused a lot of this over leverage. Well, right now, the same thing's happening for my country, Canada. Our politicians are running around assuming we're a BBB credit. And in fact, the market's pricing Canada much closer to a single A credit. In fact, we trade almost in line with Portugal right now in the credit default swap market. That's not a great thing for Canada.
Right, well, that's how Greece got into trouble, because they were having a credit rating similar to Germany. And so that created huge opportunity for all kinds of malicious activity, Stacy.
I would agree with that.
Right. So I have another question here. So we have Bitcoin fixes everything. Okay, this is the notion of that everybody in the Bitcoin community knows. In terms of this price signal, and you talk about that credit markets always signal things before the equity markets. We saw that, as you mentioned, in 2007, 2008, the LIBOR rate spiked. We were covering that on Kai's report. We didn't understand what was going on. We were mostly like looking at the coverage that Zero Hedge was providing. The other mainstream financial news was suggesting that was just conspiracy theory, that there was nothing going on there. And then obviously we had the shenanigans of what happened with the Bank of England and their role in making sure LIBOR was didn't indicate any stress. But this notion that the central bank steps in to hide the stress, it doesn't make the risk go away, but they hide the signal that something is coming, something bad is coming. We see that with gold as well. I mean, gold was always considered some sort of hedge, a gold bug, their hedge against government printing too much or whatever. But central banks own almost all of the gold, right? They own huge quantities of it, so they could push the price wherever they wanted to. So with Bitcoin, we have Bitcoin can fix in terms of sending those price signals to investors who can then understand where to allocate their capital or when to pull their capital and or get compensated properly for their allocation of capital. Do you think it's like secure from governments or central banks intervening or trying to stop that price signal?
It's a great question. So firstly, it is secure from the fact that there's no counterparty risk. There's no centralized point of failure with Bitcoin. Imagine if you had bought default protection on Bear Stearns from Lehman Brothers, because all the big investment banks offered up protection at various rates. Imagine if you had been trying to hedge a position on Bear Stearns and you bought protection from Lehman Brothers. And all of a sudden you realize the insurance company you bought the protection from, being Lehman Brothers, is in itself in trouble. And it causes this cascading or domino effects, contagion in the credit markets. The beautiful thing about Bitcoin is there is no single point of failure. There is no counterparty risk with Bitcoin. I don't believe currently that the central banks will have a direct impact on the price of Bitcoin, but that's not to say that I firmly believe in the future some smart central banks will own Bitcoin. I believe it's a far better asset to own than gold, even at the central bank level. So when they get involved in the market like that, Stacy, yes, I don't believe they'll be able to, using derivatives and whatnot, impact it as much as they can gold. But I believe if they are an owner of Bitcoin and they come into the market as a large seller because they need to raise liquidity, of course, that would have an impact on the price of Bitcoin. In the short term, we're all at rounding error prices, Max. I don't believe that 30 or 40 or 50,000 accurately represents where Bitcoin can be. When a central bank does get involved, the price will be meaningfully higher. And we'll have all experienced right now the growth of Bitcoin for the last 10 years versus the growth of Bitcoin price over the next 20 years. That's what I say to my children. Let's talk in 20 years. This isn't about me. This is about my kids.
Right. So, markets run on stories and narratives. And right now, the big money, like a Paul Tudor Jones or a Michael Saylor, is telling a story about Bitcoin and inflation, and that it's an inflation hedge and that inflation's running at a lot higher than the government is saying. But what you're saying is that there's the potential for an emerging narrative in these markets, and that would be default.
I love you, man. Exactly. That's exactly what it is. In a 10-year interest rate, there's a component of inflation expectations as well as a component of credit quality. And everyone has historically overlooked the credit quality component until now, because the inflation narrative is being suppressed, whether you believe it's truly much higher. Saylor is obviously the most brilliant man in any room that he walks into, but even he can admit he would probably have borrowed at an 8% coupon in the high yield market when he used the proceeds to buy Bitcoin. He actually was able to borrow at 6 1/8 coupon, Max. He's taking the old legacy financial system out and teaching them a lesson. Okay.
Yeah, well, isn't that a speculative attack on the central banks? Because
it could be. Listen, but you need a whole lot bigger companies doing it than imagine if AT&T or General Motors or Ford all decided to do it. And then my flip side argument is this. Look, with El Salvador, you're getting countries that are leapfrogging corporations. Everybody should have exposure to Bitcoin. But once the countries get involved, that's even a bigger event than corporations getting involved, right? Because you onboard
all these. Well, we saw it with George Soros in 1993 in the Bank of England.
Okay, yes.
He took him on with a speculative attack. He borrowed cheap and busted them, made $1 billion.
Yes, he did.
But let's talk about this word default for a second, because it has a close kissing cousin. And that word would be deflation. These folks are talking about deflation, but they're not talking about prices going down. They're talking about behind the scenes, bonds are disintegrating. The credit market's collapsing, and they have to keep propping it up by printing more money. That's what they mean by deflation. So aren't we already in a soft default? It's a soft default right now. When we hear the mainstream media say, well, the policymakers are more concerned about deflation, people confuse that term. What they should be understanding and substitute is a word called soft default.
So we defaulted, or I say we again, 1971 was a implicit default. when Nixon went off the gold standard. Yes, you're totally right. Look, it's only math. We are in a soft default. If you are in the bond market right now lending money, which I did for 30 years, I've never seen a worse risk return opportunity in bonds. But the fact is, there's 400 trillion US dollars worth of fixed income instruments out there in the world. 400 trillion. If even a portion of these people understood the real mathematics of what they're doing, it's a circular debasing of their fiat contract. Yes, they would purchase some Bitcoin as default protection, much like my paper says. And you can call it a soft default, Max. I agree. That's a beautiful term. I've never heard that term before, but that's exactly what it is. You lend $100, you're going to get $100 back, most likely. The problem is that $100 will only be able to buy you $65 versus the times zero basket that you...
Okay. Well, what about a negative interest rate bond? That's a soft default.
That is absolute insanity as far as I'm concerned. That's not an asset. That's a liability.
But it's a soft default. It's a soft default. You're selling a guaranteed loser. The banking system is admitting that
no one
it's
has
so
put that gun
structurally
to your
messed
head.
up that they
no
can't
one
even
has put
sell
that gun to your
par
head,
bonds.
though, right? No one put that gun to your head. Anybody that owns a negative yielding bond, yes, I guess we could call it a soft default. The other thing you call it, it's not an asset anymore. It's a liability.
But it's a statutory obligation by the pension funds to own these things by law. They have to buy treasuries, even if it's a negative yielding treasury. So they are putting a gun to somebody's head.
Oh, interesting. Okay. So I didn't realize that, but okay, let's say you take those foolish investment guidelines and you play stupid games and win stupid prizes, right?
What is actually going on with these reverse repos? Like what is going on? There's some sort of weird stuff people are murmuring about, but can you explain to the audience, like, why that might be indicating something happening in the credit markets, and therefore maybe you might want to get your Bitcoin insurance?
That's great. You know what? Honestly, that is not a huge worry factor from my experience. The reverse repo market right now is simply signaling there's too much liquidity in the system. There's too much money that doesn't have a home. That is not the same as a outright repo market disruption. So when the repo market disrupts, that concerns you. When the reverse repo market disrupts, it indicates too much liquidity. So what does that mean? Too many dollars, which indicates that currencies are debasing or should debase mathematically more quickly. But it's sort of like high yield bonds. Did you happen to see today that there was a high yield bond that was issued at a 2.45% 5-year yield? When I started trading high yield bonds in 1998, high yields were around 18 to 20% per annum. Now you have a high yield bond that yields under 3%. The high yield index itself right now yields about 4%. That means you have 4% nominal returns before you subtract inflation and before you subtract defaults, expected and unexpected defaults. You are absolutely going to earn a negative return on a real basis after defaults on high yield bonds. Who's doing this? Well, people that manage money that have to put that money to work because there's too much liquidity in the system. You're getting false indications again, Max. If you're Michael Saylor, you take that, the ducks are quacking, you take that to the bank, you borrow from them at low rates, and you put the money into a non-debasing store of value called Bitcoin.
All right, let me ask you my Michael Saylor question, because he stirred up some interesting market chatter recently, because after doing these preferreds at the low rates to buy Bitcoin.
The converts, I think you mean the converts, right? The convertible bonds.
Yeah, the converts. He's done a shelf offering for $1 billion worth of equity.
Correct.
And he's saying, "Oh, I'm gonna use that to buy Bitcoin." So my question is this: the converts, he has a certain runway there because at some point the debt to equity ratio would be seemed as a credit risk, so he can't do that indefinitely.
Correct.
If he does $1 billion shelf offering in stock and buys Bitcoin with it, so he's essentially, by increasing the equity side of the balance sheet, isn't that freeing up room to do more converts?
Everything is always mathematics correct. Remember, a convertible bond is primarily an equity derivative to begin with. Okay. The reason he got a 0% coupon on the bond wasn't because he was a 0% credit risk. It's because the optionality in that spread was compressed because the convertible arb desks wanted to play the volatility of the underlying stock. You had to look to the high yield market that was not a convertible instrument to see what his true borrowing rate was, and that was 6.125%. Now, that 6.125% was probably cheap in his mind, but relative to the high yield index at 4%, it was a 200 basis points pickup over the index itself. And he's only a double B minus rated credit. So, he was a good rated credit where the high yield managers figured they were getting a very attractive risk adjusted return. So you need to look to the high yield market for true credit signals, not the convertible market, which again is an equity derivative. But your logic applies. You issue more equity, you raise equity. Yes, your debt to equity ratio goes down. Implicit in that is your credit quality goes higher, which means you can issue more debt to buy more Bitcoin. The man he's rewriting the rules of capital markets. There is no question.
Now, does that become something of a Bitcoin machine versus, let's say, the economics of going out and deciding to get into the Bitcoin mining business? Because you get into the Bitcoin mining business and it's CapEx. You're buying stuff. You've got price exposure. You've got to hedge that. Okay. Instead of getting into mining, he's saying, let's just turn our balance sheet into a virtual Bitcoin mine by doing this equity to debt on the balance sheet, by raising equity. And then we're going to go do some more convertibles and then maybe raise more equity. As long as the price keeps going up, we can play this game all day, right?
Absolutely. And in fact, the price doesn't even have to keep going up. It's a function of the markets and providing you with the ability to borrow more and leverage more. Michael Saylor, as smart as he is really still a pretty small cap or small enterprise value company. Can you imagine if one of the bigger Fortune 500 or, call it a S&P 50 company decided to employ this same, call it market arbitrage? It would be brilliant. And my God, people would look at each other and say, I got to do the same sort of thing. Personally, I don't think Bitcoin mining as a standalone business is a great business. I'm involved in the energy business right now that we do sell energy to Bitcoin miners. Bitcoin mining doesn't control its input costs, which are predominantly electricity, and it doesn't control its output, which is the price of Bitcoin. That's not a great model. So Saylor's very smart. He's like, yeah, I'd rather do this in a function where I am not exposed to energy input costs. I'm just exposed to the output cost of Bitcoin, which he is convinced is going higher, and I agree with him.
All right. So MicroStrategy stock ends up being a leveraged Bitcoin play.
A little bit. You know what? Look, when the U.S. finally gets their ETF, their Bitcoin ETF, a lot of this demand for the MicroStrategy exposure might turn elsewhere.
But it's a leverage play, though, isn't it?
It is 100% a leverage play because he's using leverage.
Yeah, he's the only leverage play out there, so it doesn't really compete with an ETF.
Well, true that. Okay, true that. Yeah, but he also has another business behind it that creates $50 million a year of free cash flow.
Yeah,
right?
He's got his day job of selling enterprise software, right?
And look, you interviewed him in Miami. It was brilliant, and he said himself, look, he thought he was about to retire, right? Or I don't want to put words in his mouth, but he's found new life in Bitcoin. And also what he's found new life in is teaching us idiot bond investors how actually to value risk. Okay. And as long as we're going to lend to him at 6% per year, and he thinks it's debasing at 15% a year, he's going to issue more and buy Bitcoin with it. So
right. The risk is right that it's dilutive, because he is issuing a lot of stock with the convertibles.
No, well, don't forget, the converts are not obligated to convert back into equity. And in fact, the strike price on the convert in the second issue is so far out of the money that it's non-dilutive right now. And then the high yield issue is not dilutive at all. So
who bought this thing?
High yield managers, again, of which I used to be one of them, that looked at it, Max, and said, the whole index itself is yielding 4%, and I can buy this higher quality credit called MicroStrategy at a 6% yield. That 200 basis points is that's what people are in the business of investing for, to pick up that less risky, bigger return option.
So there is a bigger company, and that was Tesla, and they bought some Bitcoin. And okay, the guy is a bit of a maniac, but I want to ask you about in terms of risk, and you've just brought this into the conversation and credit risk. Do you think this ESG sort of anti-Bitcoin mining FUD, is it just FUD and it'll go away? Or do you think that will actually do bond investors, do investors look at that and will it matter to Bitcoin?
100%. So I was on a Spaces call last night with Lord Futusia from Tonga. And he has been offered an opportunity for a green bond in Tonga. A green bond, basically being a ESG compliant source of fixed income. These things are beautiful. Do I think that they're smart? No. In fact, I think a lot of the ESG narrative is a little bit contrived. Let's talk about Elon. Do you think that his electronic vehicles aren't charged using any coal-fired electricity, for example? Come on. I mean, some of this is downright disingenuous. I'm in Canada right now. I'm in Quebec, where hydroelectricity is supposed to be a green source of electricity. Let me tell you that my business partner is 100% Indigenous Canadian. He doesn't think a dam that floods Indigenous land is that green. Okay. Like, it might be green because you think it replenishes itself using rainwater, but the tons and tons of concrete that go into building that dam, as well as the land that's flooded, maybe that's not quite as green after all. So a lot of these, much like any regulation, there's lots of holes in the regulation. One statistic that I particularly like is that one volcano emits more carbon dioxide in 4 days than the entire global population produces in 1 year. Okay. Do you think we're going to control carbon dioxide on Earth when there's hundreds and thousands of volcanoes that are spewing out natural carbon dioxide? We don't even matter. But do we hear about stuff like that? No, because it doesn't fit the narrative of the politicians that are trying to defend the world. One of the worst politicians on that front is Justin Trudeau of Canada. And yes, I call him out for failing grade 11 math. And I also call him out for promoting a narrative that's absolutely counterproductive for the population of Canada.
So, Greg, what do you do these days? It says here you're a former bond trader turned Bitcoiner. What are you doing? Are you on the front line selling stuff? Are you in the markets? Are you just hanging out waiting?
I trade a personal portfolio, Max, but the most exciting thing I'm involved with is a company called Validus Power, which, again, the owner or the founder is 100% Indigenous Canadian. He's been in the power markets, in global power markets, for 20 years. We have a product that you can wheel in a 35 megawatt jet engine on the back of a trailer truck, attach it to a source of flare gas, and in 6.5 hours, you're up and running with 35 megawatts of power. Not these 1 megawatt diesel generators, which are very cool in their own right, but we have enough power in one jet engine to power a data center for Amazon Web Services. We are actually going into fields. It's been field tested for 4 years. We're going into fields and producing electricity using wasted natural gas that otherwise would be burned into the atmosphere. Or if you don't burn it, it goes up and destroys the ozone. So why can we do that? Because we create a revenue stream using Bitcoin mining with an energy source that was otherwise being wasted. So that's a narrative that I can embrace. I'll tell you that Bitcoin mining is the marginal consumer of energy around the world, electricity. And that's such a good thing because it stabilizes energy grids. It is the most perfect solution to the closed loop, as an engineer that I am, and as Michael Saylor talks about, the conservation of energy principle.
So you're talking about like a Rolls-Royce jet engine?
Yes, man. That's
okay,
exactly
and so
what we have.
You buy them from Rolls-Royce, or General Electric also makes them?
General Electric, sir. And they're produced in Texas, and we own them at Validus Power. And we have signed, amongst others, a Bitcoin mining contract with HUD 8, which is a Canadian listed Bitcoin miner. that's using natural gas produced through these turbines, and part of that natural gas is wasted flare gas that would be polluting the environment.
How long has this been in operation, been up and running?
This company has been up and running for 20 years, but the Bitcoin focus has only been recently in the last 2 years, and that's when I got involved.
All right. So is that a growing business? What is that? Is all happening?
All I will say right now is the phone won't stop ringing because of the power or the requirements from Chinese miners that are migrating west from the current, from their current homeland in the east.
Okay, so that's a bit of a windfall. So the narrative is that the Chinese miners go offline and the difficulty adjustment adjusts, and we have a new set of winners. Texas looks like a winner. Kazakhstan, possible winner. You just described your business. That sounds like a winner. Is it true that the center of gravity for global Bitcoin mining is moving out of China and going elsewhere?
In my opinion, yes, that is true.
All right. Well, there you have it. I love the jet engine story. That is something that is new to me, and we're going to dig deeper into that. I might also add that you're there at a pub, an Irish pub up in Canada, just so people look at your office behind you and think, like, what kind of bond trader was this guy?
This is an office. For 25 years, I've been a member. I've been a partner in our first Irish pub that turned into 8 Irish pubs. It's a big night in Canada as we're going against our Montreal Canadiens are in the Stanley Cup for the first time in over 30 years. I guess since 1993. Anyway,
yeah, I feel very, very bad that the legend that is Don Cherry is not on the airwaves.
He is so my son Don Cherry is an institution in Canada. I believe the man is as honest as the day is long. Perhaps he says stuff sometimes like myself where we get a little over our skis just out of passion. I'm dying, Max, to be you one day where you do get the opportunity to debate a gentleman like Peter Schiff, because Don Cherry tells the truth. I try and tell the truth. Don Cherry got moved aside. We have to call out the pretenders. Don Cherry was trying to call out the pretenders, and that's unfortunate.
Well, Don Cherry called us a bunch of jerks because
North Carolina.
He called the Carolina Hurricanes fans as a bunch of jerks. That was one of his.
So that was because. So what was that because of? I remember the incident. I don't.
Yeah, because after the games, the Carolina Hurricanes
used to salute the fans.
Well, they used to do like a routine, almost like a comedy routine, where they would play baseball and do things like like all kinds of things after the game. And he said those guys are a bunch of jerks.
I remember that.
Let me explain that my sartorial aspirations have always been tied to Don Cherry since the 1970s Canada versus Russia, our Soviet Union hockey series, where he showed up in those incredible outfits. And I was like, that guy knows, how to dress. That's my aspiration.
So I tell you what, he actually dresses like that in real life as well. He would attend some of the hockey, the minor hockey games in Toronto, because he's a just big hockey fan up and down the whole spectrum. And I'll tell you, look, the guy is a passionate Canadian. And 1972, I remember it like it was yesterday with Bobby Clark and breaking the ankle of the Russian. Whether or not that was an accident or not, I'm not going to say anything except that Don Cherry was there defending Canada. And Phil Esposito, you remember he got on the television and he's, it was a much closer series than everybody thought. And he's like, come on, Canada, we're trying our hardest. Darn it, we need some support. And Don Cherry grabbed that moment and just said, okay.
Yeah. It was a seminal moment in the history of international hockey.
Yes.
And how do you feel about Montreal Canadiens? Of course, they've won the Stanley Cup 24 times, more than any other team in history. And they're going to play Tampa Bay. Now, Montreal was one of the first 6 of the original NHL teams, right? Yeah. And now we've had this period of expansion, and we actually have a team in frickin' Florida, Tampa Bay, Florida.
The team in Florida is really good, right? Like first of all, there's United States players. There's more, I think there's 14 Canadians on the Tampa Bay team. It doesn't matter. They have a product down there that's beautiful. There's a kid, Braden Point, that he scored in 9 consecutive playoff games. That was he only needed one more game to score a goal, and he would have tied Reggie Leach from the Philadelphia Flyers, famous Broad Street Bully. So look, it's good for hockey. It's good to have a team in Tampa Bay. It'll be even better when there's a team in South America or a team in overseas. Maybe that'll be logistically impossible, but we're proud Canadians. But there are actually more U.S. kids in minor hockey than there are kids in minor hockey in Canada. And that's just a function of your country being 330 million people versus our country being, 35 million people.
Yeah, but we don't have the maple syrup that you have.
Well, you don't have the maple syrup, but you have a lot of other pretty cool things so look, the quality of hockey in Massachusetts, in Minnesota, in Detroit is just second to none. It's, our kids go down there and play some incredibly good opposition, and that's why there's a team in Tampa. Did you know that the touring team from Florida in the minor hockey ages is one of the top teams in North America? A touring team that gets on the plane every weekend to fly to competitions in mostly up near the Canada-US border. But that's a beautiful thing. That's commitment.
All right, one last question. Pound for pound, putting aside the historical records for a second, pound for pound on any given night, who's more talented, Wayne Gretzky or Sidney Crosby?
Oh, my goodness. Great question. I thought you were going to bring Connor McDavid in there because Connor McDavid's an age 97 and my son's an age 96 and played a lot of hockey with Connor. I'm not going to go out on that. Pound for pound, I would say Gretzky, because Sidney has a huge, a huge backyard. Let's put it that way. His thighs and his hips are massive. So pound for pound, Gretzky. Pure hockey sense and scoring big goals. You can never take that away from Sidney when he scored that goal in the Olympics, right, to win the gold medal. Yeah. So I'm not going to go out there, Max. I'm afraid. Let's just say this. I hope someday they'll all be Bitcoiners. Is that fair?
Yes.
I want McDavid, Gretzky, and Sidney Crosby to endorse Bitcoin like Russell Okung and Richard Sherman, and even Tom Brady.
Yeah.
This is what we need in Canada. We need some of these guys to actually understand the mathematics of why you need to get paid in Bitcoin.
Yeah.
Oh wow, this is amazing. So you look like Jacques Plante there, or Bernie Perront with your mask, your hockey mask.
Yeah, well, we ended up talking about hockey, and I'm hoping that Her Royal fucking Highness Stacy Herbert gets all the hockey players in the world to start stacking sats at swanbitcoin.com/orange pill. You get it? Otherwise, I'm going to hip check you.
Yeah, definitely. That's 2 minutes right there for unnecessary roughing. They get 2 minutes, or sticking, high sticking. And excellent, brings back memories.
Right. So let me look at this. So, the thing is, that was a very long interview there with Greg Foss. I hope you enjoyed it because it's like, it's that side of the market, that credit market and the bond market and things like that. I don't think people really understand just how huge it is compared to equity markets that, the Robin Hooders and like most of the mainstream media focuses on that, whereby it is the bigger credit markets that are always running things. I mean, Max and I covered that in the Kaiser report in the lead up to the whole financial crash. We saw the LIBOR rates, like the crazy things starting to be signaled there.
Yeah.
Until they crushed that price signal.
Yeah.
And then now, like in the repo markets or whatever's going on there, and now the reverse repos of $1 trillion because all of that liquidity. We're talking about all this money everywhere. Everybody's get free money. Everybody has free money. And then, of course, there's too much liquidity. So these reverse repos, and it's just like nonstop. It's exhausting, right? To plug all these like holes of all the stuff you're trying to control.
Yeah. There's too many dikes, not enough fingers. Right? I mean, like the little boy put his finger in the dike, right? That's a famous story. I don't know what else I could possibly be referring to.
I thought you were talking about the Orange Pill podcast Telegram room. Madge Weinstein refers to herself as the D word. In fact, we're going to have a little clip of Madge Weinstein on Monday. We're going to do a special broadcast. Our microdose will be on Monday because, we're then traveling to Austin for the hottest show in Bitcoin. And that's by the way, I just want to point out that reverse repo stuff that's happening. Apparently they're afraid of breaking the buck again. And that was funny because that was the problem back in 2008. Remember, that is what triggered TARP and all that other stuff. And
that's right, breaking the buck. So the money markets are not backed by one for one. They're not backed one for one. They're built by highly leveraged short-term credit instruments. And if there's a problem, then your money market suddenly is negative. So, and that has a perception that'll scare people because it's like, oh my gosh, the money in my wallet just got degraded, essentially. So they will do anything they possibly can to stop that from happening. But as we said in 2008, when they did it the first time to save the buck, their solution was to triple and quadruple down on everything that made the crisis happen, and that there would be a repeat within the 10 to 12 years, we said explicitly. And now here we are, and it is repeating, and it is much worse.
It also does lend credence to some of our guests. It's hard. There's so many moving parts in this whole command and control monetary system that we have that it's hard to know inflation, deflation, hyperdeflation, hyperinflation, like where it's going to go. And we have had people over the past few years, once we saw the negative interest rates happening in Europe, whether or not it would happen here. And while there might be negative real rates, many said that they would never be allowed to, as a reserve currency, go negative officially.
Look, I mean, the idea of prices being pulled higher by demand is not what we're talking about. We're talking about credit defaults. We're talking about bond failures that are prompting money printing, which is now leaking out in uncontrollable ways as higher prices. Right. So that's what we're talking about. And so that's why the terms inflation and deflation get mixed and matched, and there's confused. And because it's deflationary in the sense that you've got a soft default on U.S. treasuries. They're defaulting like they did in 1971. The U.S. Treasury market defaulted. Nixon closed the gold window. And now here we are in 2021 with Venezuela. El Salvador has now gone on a hard money standard, and they're now leading the world. And the U.S. is now really defaulting. Right.
Well, Greg Foss, he had a good argument there for Bitcoin being a credit default swap, essentially against all of these fiat currencies.
Right. So the imputed value of Bitcoin based on extrapolating a blend of all credit default swaps on sovereigns would be $2 trillion. So it's currently worth what, 7? So call it a triple
3x from here.
Yeah, 3x from here. So what is that? That's what are we at now? We're at 34. Let's call it 35, 70. It's over 100,000. Would be the over 100,000 per Bitcoin would be the imputed valuation based on a blend of all sovereign credit default swaps. And of course, markets shoot up and down. So the market is underpricing Bitcoin by a huge factor. And of course, once it gets to fair market value, it very likely will overshoot. That's how I get to my 220,000. I think we'll get to fair value, and then we're going to overshoot. And then we'll see, possibly, I open this to revision, but possibly at 220,000 in 2021, then we'll see a real pullback, a more cyclical pullback. I'd have to look at that once it happens. But at this moment, we're just seeing a pullback that's not a cyclical pullback. And that's why it's going to bounce back to new all-time highs, bounce back to 220,000 to make a cycle high. We're looking for that cycle post-halving high.
Well, I think this is a good time to wrap it up and say, Greg Foss, our guest there, just pointed out that Bitcoin is a great credit default swap, and you can go stack some of those sats over at swanbitcoin.com/orange pill.
Yeah.
Those sats are going to be more valuable to you than toilet paper in the next crisis, probably, I would think.
Right now, you can buy a car with 1 Bitcoin. Pretty soon, you'll be able to buy a car with 1 sat.
That's
$30,000
pretty
a
extreme.
sat.
Well, that's what it did in Weimar, Germany. So, the likes of Michael Burry are saying that's coming. So,
Yeah. Michael Burry, he hasn't capitulated yet. He's still on the Bitcoin bear train. That's the wrong train to be on.
well, we'll see you on Monday. Thanks a lot for joining us.
Goodbye and adios. And until next time, that's it. Goodbye.